So if you've got an inferior vanadium project and you're saying it's going to be fine because the price is going to be through the roof because of vanadium batteries, they're deluding themselves. The market is growing strongly, even without vanadium flow batteries, and there's every reason for it to continue. One of the advantages of our project is that we can survive the downturns. We're still very profitable, even at the very low prices. We'll be the lowest cost producer, we think, in the world, not just the lowest quartile. And it has the scale to transform the world of vanadium.
Hello and welcome to Crux Investor. We're here today with Nick Bridgen, the CEO of Ferro-Alloy Resources, listed here on the LSE. Hello Nick, how are you?
I'm fine, thanks. And I should say we're also listed on the Astana International Exchange.
Very good, very good. Is that a big exchange?
We'll see, we just started.
Right, just started, okay. Well look, Nick, we always get people to kick off the 1 minute summary, helicopter view of the company, and then we'll get stuck into some questions. If we
All right, seriously, 1 minute. What we have is a very large vanadium deposit. Now there are lots of very large vanadium deposits around, but ours is very special in that it's a very different type of deposit. And it's amenable to a much, much simpler processing treatment, which means that our costs will be the lowest cost producer, we think, in the world, not just the lowest quartile, and it has the scale to transform the world of vanadium.
Right, okay. So let's kick off with, again for people not au fait with the vanadium space, because it is quite complicated, fairly volatile commodity. What's been happening, and what's your view of what's going to be, what the market will look like?
Well, it is volatile because it's quite a small market, and quite a lot of it is produced as a byproduct or a co-product of steel, and therefore the supply is relatively inelastic, the demand is elastic, and so you get these big peaks and troughs.
Yeah.
Recently we've had a shortage caused by a long period of low prices. Certain production dropped out of the market. China has recently implemented new construction standards that effectively require the sort of steel that requires vanadium. And so there was a shortage. The price in 2017-18 started to go up. It's overcorrected now and it's gone down to below its normal long-run average.
Right.
But I have to say that one of the advantages of our project is that we can survive the downturns. We're still very profitable, even at the very low prices.
Right, okay. People sort of refer to themselves as the lowest quartile producer, but let's talk about the market perception for a second. So price did go up to what $28-30 last year. People got very, very excited about that. But and the way it's been positioned in the market now is that the prices have come back, have dropped, have fallen significantly. But you're saying, actually, that was the exception. The norm is around the $7.58 level, where the price is now, and that people shouldn't be alarmed about the falling price. People need to be able to operate at around these levels economically, or they shouldn't be trying to.
That's exactly right. I think that depending on what period you look back over, the 10 or 15 year average price corrected for inflation is around $7. We're slightly below that now, but it's been down this and even lower for very long periods. So our project is aimed not at even the average price. We're aimed at making good money even in the very lowest prices that there have ever been. Okay,
well, we can talk about your feasibility or augmented feasibility study later. Again, let's just stick with the market for now. So 90% of this market destined for steel.
Yes.
Right? Other 10%, battery market, battery revolution.
Battery hasn't happened yet, but yes.
I know, I appreciate
that's a big
that,
part of the story.
What we are hearing from a lot of vanadium companies, perhaps with inferior projects to yours, they're trying to suggest that they're going to be part of the VRFB story going forward with that. And for us, that feels like quite a long way away. You've stayed away from that story deliberately. Why?
Because I'm not certain that it'll happen, firstly. I think it will. I'm quite an optimist. But the other problem with the battery story and basing a strategy on batteries is that the flow batteries require a low price. They will only be competitive against other technologies, other battery technologies, if they can buy vanadium.
Or energy technologies, full stop.
Yes.
Right.
Well, both. They need a price. They're telling me, we talked to them all, and they're telling me they need a price to remain competitive against the developments of lithium-ion batteries. around $5. Well, that's lower than most people's expectation.
Yeah.
So if you've got an inferior vanadium project and you're saying it's going to be fine because the price is going to be through the roof because of vanadium batteries, they're deluding themselves.
That's really interesting. We've not heard that point before. Okay, and you think even with VRFB, with large-scale VRFB projects, they're still not going to be able to get those economies of scale to pay for anything above $5?
Yes, I think right now they can probably survive a little higher price, but lithium-ion and other competing battery technologies are improving every year. So they're looking forward and thinking they've got to target an overall price position which really requires.
Do they compete, the RFBs, long-term storage, lithium-ion, short-term? So are they competing? Should they be compared?
They have their niches. But you put your finger on it. Lithium-ion is really high energy density, therefore lightweight. Therefore it's used in cars and mobile phones and laptops, obviously. And the niche for vanadium flow batteries is fixed, heavy ground storage, where there's full charging every day and full discharging. For example, from solar energy, when the sun shines in the day, you've got to charge it up and then completely discharge it at night. Now, at the moment, lithium-ion batteries don't do that very well. So if you look at the battery space, lithium-ion is for all the shorter-term backup, 1 hour emergency supply niche, and of all the mobile applications. And flow batteries are for the heavy load. But the dividing line between those niches is moving. Because lithium-ion is so much cheaper, lithium-ion batteries, typically you throw them away after a few years because there is contamination of the materials, which you don't get in a flow battery. So a flow battery lasts indefinitely.
Yes, recyclable.
But a lithium battery has a short life, but it's much cheaper.
Okay, so I think we have covered off on some of the other videos, battery recycling on the lithium-ion side of things, with people like neometals. Maybe a conversation for another day, because you've stayed away from VRFB deliberately. You are focusing on steel as a future destination for your product.
I'll just say that I'm not steering away from it completely, because we have a very large deposit. And I think that we can, because of our cost structure and because of the size, we will benefit enormously from vanadium flow batteries when they get going.
Okay.
In that we can increase our volume and still make good money at the sort of prices they can pay.
Interesting. Okay, there's the thesis for the vanadium market, or there's a story for everyone to kind of get into and do their own research. Let's get into your project. You're in Kazakhstan. Some people don't know Kazakhstan. What's it like to do business there?
Every year I've been there. I've been working in Kazakhstan since 1993.
Right.
And every year it's got a little bit better, a little bit more normal, and it's now, I'd say, a middle-ranking country to do business in. If you look at the World Bank statistics, it scores quite highly on ease of doing business and the usual scales. It's now a well-run country. It's head and shoulders above all the other stans in terms of its government and the progress it's made.
Okay. No, I worked there in sort of late 2000s, oil and gas. It could be difficult at times, but you've been there a long time, Russian speaking, finding it easier to do business.
I find it very understandable.
Okay, talk about your project. What have you got?
Well, the first thing to be said about it is 90% or more of the world's production of vanadium originally comes from a material called magnetite. To give it its full name, it's titano-vanadiferous magnetite, or put that in a different order, TVM deposits.
Okay.
And that's a form of iron ore. It's a fairly low-grade iron ore, and therefore if you use that iron ore to make steel, it's more expensive. There's more shipping costs to move the iron ore around per ton of iron than hematite. Hematite is the main iron ore which comes out of Brazil and Australia and accounts for most of the steel production. But if you make steel out of magnetite, you can recover a vanadium byproduct. Or co-product. It's important to the story. Now, some people think that's low cost. It's not really low cost, because you're making expensive steel. The steel you make is more expensive, the process is more expensive, you're dealing with a lower grade iron ore, which means you're using up more production capacity to make less steel. So so that the economics of that business are expensive steel, but with a credit for vanadium. That's about 70% of world supply at the moment. And when that vanadium grade, which is inside the magnetite, gets high enough, in other words, a TVM deposit, then that can be developed as a primary product. And that's what Largo are doing, it's what Bushveld are doing.
Yeah.
And the problem that they have, the reason why that material is expensive to process, is the iron ore. You can't directly dissolve the vanadium in acid,
right,
like we do, because the iron ore consumes all the acid, and you end up with huge waste products and a huge acid consumption. So they get round that by first making a concentrate where they're roughly a 2 or 3 to 1 concentration ratio, so they've got a bit higher grade to start with. They start off with somewhere between 0.5, or in Largo's case, they've got an exceptional project, 1.15%, and they upgrade that to a concentrate, and then they roast it. And they roast it typically to 1100 degrees, which is expensive. You're heating up an awful lot of earth and rock to get a very small amount of vanadium. And so the concentrated process, then the roasting process, and then typically they have a regrind after that. That is all designed to get a product that they can then leach. Whereas our product is leachable from the beginning. We don't have those steps.
Right.
Now, if you have a TVM deposit, you've got to concentrate it. You lose some of your vanadium in the concentration process. Then you roast it, and then you leach it. You've got all this cost, and it's very big capital cost. Roasters are expensive to buy. Bringing the power in means a lot of infrastructure costs, and you end up with the best of them. Largo's exceptionally high grade and very high ability to concentrate means that they are one of the lowest costs. But they have $3, I just read recently, $3.30 or something as their expected cost, cash cost of production. On top of that, you've got almost another $1 of capital maintenance costs.
If I may ask about this setup there, because we touched briefly on the feasibility study earlier. What's that telling you with regards to the capital requirements? Well,
I've told you half the story. One reason why our capital costs are very low.
Yep.
Because we've got a very simple process. We can directly leach. We do use an autoclave, but it's fairly low temperature and low pressure, so it's nothing to be frightened of. So our plant is very low cost.
Yep.
The other advantage that we're just gifted is that we have all the big ticket infrastructure is already there.
Okay.
We have a high voltage power line crossing the corner of our site already.
Is that connected?
We're connecting onto it now. At the moment we're getting power from a little local reticulator.
So when is now? When is that actually?
Well, we're halfway through the project. Around the end of March, we're in the hands of subcontractors, so we can't really control it very well. But March, April, sometime around then.
All the other water, power, roads, etc.
And road, we've got a metal road already within a couple of 100 meters of our site. Now those things, as you know, in a mining project in Siberia can cost hundreds of millions of dollars. We've got them already.
Yep.
So simple process, infrastructure already there. The mine is simplicity itself. It's outcropping. It's shallow lying. The cross section is very long, kilometres long, but the cross section is just a sort of syncline, a U shape, which ideally fits the contours of a pit. So there's very little. There's no pre-stripping, little infrastructure, and a simple plant. So the feasibility study number that we've done so far is coming up with a figure all in, including soft costs and hard costs and owners' costs and hardware and everything, of about $100 million. Now we're doing that again now, and it may go up a little bit, but that's the
sort of quantum we're talking about. Okay.
Whereas an equivalent TVM deposit, just to do the basics of what we're doing, is probably at least 3 times that.
Given you are the cheapest in the world, the price is doing what it's doing at the moment. People's perception in the marketplace that vanadium is volatile. You're saying, well, the reality is we had a bit of a peak last year, and some people took advantage of that, produced a bit more cash. Great, but the price is roughly where it needs to be. Your share price has suffered over the course of the last year. It's fallen away from when you listed. What's happened? Do you know?
I think what's happened is that we listed at a difficult time. The price was already falling,
right?
And the perception, as you've just said, was that this was bad news for us. We actually, all our material at the time of our listing was using a long-term forecast of $7.50. The price, as you said earlier, had been $28, and it was already down to about $17 when we listed. But so instead of being a momentary bonus, which it is a reality what it was, the market perception was it was a catastrophe for the industry.
Right.
On top of that, we've had a lot of selling of
Why?
shareholders. We had a lot of shareholders. We'd been a private company for a long time, and amongst our shareholders there had been the usual divorces, deaths, and institutions coming to the end of their lives that needed to liquidate. So we've had a lot of selling, and I think the combination of the falling price and the selling meant that when the market was reacting to selling, it was sort of conflating different issues.
Right.
And I think we've come to a very low position. But as I think we're going to come to in your questioning, the fundamentals of the company are excellent, and really it shouldn't be where it is today. I know every CEO says that, but
they do.
But
they do. So what do you know what you're going to do about that? Because there's a big overhang. Because you listed at what, about 70p?
Yes.
Something like that.
Yes.
We're down around what today?
14.50.
Okay, so significantly off.
Yes.
And market perception or not, you're going to have a lot of shareholders who are way above the 14 cents. If this thing if it does recover and gets anywhere near 70, you're going to have a bit of an overhang there. People are going to be selling to the market again, unless you can tell a story which suggests it's going to go back up and beyond. But can you do that?
Sure.
What are you in control of that's going to allow you to be confident or give the market
confidence?
Well,
what we're in control of is developing the project and controlling the dilution. If we can do both of those things, then the price should be up in multiples of where we listed. I mean, to give you a rough idea, I mean, our competent persons report figure based on a long-term forecast of $7.50 shows an NPV of $2 billion for the project.
Right. Who did that?
That was GBM.
Okay.
And we have 313 million shares roughly outstanding. And now that I can't do the calculation in my head right now, but that is, I don't know what it works out at, £10 or something.
Right.
And that's where we've got to get to. Now, obviously...
So I'm interested in, how do you get there? What are the steps?
Yeah.
What are you going to do?
The steps that we need to do are these. We've already done a feasibility study on a local basis, but we need to augment that and supplement it and issue it on a Western bankable feasibility study basis. Now that's what we're doing now. Okay. And I think there'll be instant credibility the moment that gets published. At the moment, because we don't have that document, the market...
Do you think you're being marked down for that? They want to see this Western version of the numbers you've already told them.
I think it's a part of the reason for the share price.
Let's say that's one thing.
Weakness.
What else have you got?
And that will then the other half to this is to develop it without too much dilution. Now, because we've got a very, very high profit margin, I think the competent person report showed a 79% profit margin. It means that we can develop this without a great deal of equity dilution. Yeah. Possibly even no equity dilution, but that's an aspiration. And the way we'll develop the project is maximum of debt. Now, the project can take the debt. It can meet all your bankers' ratios very, very easily. So it can take the maximum that debt providers said. So that's say 70%. We are likely to target export credit guarantee, probably British, but others are available. The
EBRD,
the British EBRD we'll talk to, or we are talking to.
Right.
All the usual culprits. There's nothing in our project that it is very attractive as a banking proposition once the feasibility study is done. So anyway, the principle is maximum of debt. And now the other 30%, how are we going to do that? First of all, we have an existing operation. We haven't talked about it yet, but it's very small in the grand scheme of things, but it's helpful because it means we've got an employee base. We know what we're doing. We've got 150 employees, and that operation is scheduled to make quite a lot of money once it's fully cranked up. We're cranking it up now. So that will contribute to the other 30%.
How much is it contributing now? And what's it going to
right now,
contribute?
if you don't mind, can we come back to that? Because it's easier to sort of tell you the no dilution story on the big project. So that other 30% that isn't going to be covered by debt, a lot of mines nowadays are financed not by equity but by royalty sales and streaming deals and things like that. Well, we've got the capacity to do that, because the problem is if you've got a marginal project as sort of the next off the block copper project or something like that, and normally the margins are wafer thin, and if you finance it too much with royalty sales, you saddle yourself with a problem for the future.
Can do, yes.
But if you've got a 79% margin like we have, you can sell a 1% royalty or whatever, and it hardly impacts on your profit numbers going forward in the future. Okay. So we will target financing it with non-equity.
So what are the conversations you've had today? So, royalty, streaming, you're saying maybe a lot of it in debt. Have you had equity conversations? Structured finance? What are the conversations you've had? And more importantly, what's the response you're getting? And why
we're getting a very
today?
Positive response.
Right.
I'm not sure I should name names, but we've been to some of the obvious providers, and all of them have said yes. First of all,
yes to what?
Well, yes to a process starting. Of course, they need to look at feasibility study. Right. They need to do their due diligence, but they're not. They know the space, the vanadium space. They know Kazakhstan and the results, and they know our company, and they would all the companies we spoke to would like to be involved. That's one specifically on a streaming basis. We have we went through the initial screening process of the development bank in Kazakhstan, and we passed that. So we're now working with them on the next stage. Certainly the usual culprits that you will know we talked about earlier, EBRD and the time we're talking to, they're all at an earlier stage, so there's no sort of milestone to report, but we're having very positive conversations with all of them.
Okay, but they're just beginnings of conversations. They'll take a while to get over the line. So can I just understand, if you can give an indication of what's your thought around timing for that? Because the feasibility will take how long?
Around 9 months.
9 months. Okay. So towards the end of this year, feasibility in the bank. These conversations will start firming up at that point. Is that what you're saying? Or
that's right. The feasibility study is the document that everyone is interested in.
Get it.
And that's what makes it serious. Until then, you can go through processes, but nothing is likely to be concrete until that document is there. But if I can split, I think you're alluding to it in your questioning. There's the project and the project finance, but that starts end of this year with the feasibility study, and then there's the period building up to that now, when we're doing two things. We're expanding the existing operation and doing the feasibility study.
It's exactly what I was getting onto. Is how much cash have you got now, and are you going to be able to get through to the end of the year to be able to deliver everything you need to this year?
There is a funding gap. We don't have currently enough to do everything that we said that we'll do.
How much have you got?
I don't think I can say that, because we're at the end of the year. We're already inside a dealing period. But if you look at our last press release, we alluded to the fact that we need more funding. Now, we've got one advantage: we're debt free. We're debt free and options free, so we have quite a lot of debt capacity, even at this stage. We've got an operation and it's moving around now into profitability. It's volume dependent. And,
well, let me come back to that question then, but deal with the operating business. You said you've got a small operating business, 150 people, and you're going to upscale that, ramp it up this year. Okay, so that's producing cash for you at the moment, but it's not profitable.
Yes.
Right. So how much money do you need to spend on that to get it into profitability?
Well, the money we're spending at the moment, we've already, it breaks down. It isn't a two-stage project, the expansion, but it breaks down into two parts. One we've already done. We've already brought the capacity of the plant, the sort of nameplate capacity, not quite the same as what we're producing today. I'll tell you why in a minute. From about 12 tonnes a month, 144 tonnes a year, to around 600, 700 tonnes a year. That's the capacity of the plant. Now, we're not producing that at the moment because we need the power. We talked earlier about the power. We're connecting on, and that will let us to run all the equipment reliably. At the moment, we have a lot of interruptions, which cause lots of downtime, and it wrecks equipment because of the instability of the power.
Right, is that the only thing holding it back?
That's the only thing that's holding that first stage back.
Right.
We've completed the work on the plant. Now it's just really the power to unleash that properly.
And the money?
Yes. Well, like I say, we've already done the work and spent the money on the plant.
But you don't need any more money to kind of get that?
So on the plant, no, to get to that 600. We are spending money on the power.
Right.
We've already spent about $1 million, and there's about $1.5 million still to go on that.
Right.
That's a connection. It's mainly transformers. It's about 1 kilometre of line, and
not significant. But have you a sense of what that number is?
Well, another $1.5 million.
Okay.
And then there's the final part of the jigsaw of upping our capacity. We said at the time of listing we were targeting 1,500 tonnes a year. Like I said, we're up to 600-700, so sort of halfway there. Is a electric arc furnace, and that project is a couple of $1 million.
Right.
So we've got about $3.5 million of big.
So these are not big ticket items per se, but they release the ability to get into meaningful.
That's right. And then the feasibility study, there's about another $1.3 million or something.
So I'm hearing $5 million at the moment.
We are investigating debt capability.
Okay.
And as much as we can get from debt, we will. And otherwise, yes, there may be a small equity raise.
Right.
But that we're hoping will be the whole dilution before we get to that $2 billion of TV.
I've no problem with that. Because that feels like for every dollar you spend, you're going to be creating dollars, as opposed to sinking money into resource development or drilling or whatever, which doesn't necessarily, in the current market, see a bump in share price. So I don't have a problem with that. So $5 million in some structure or other is what you're saying.
Yeah.
Debt, equity, probably. May even get someone to come in. Would you get any kind of royalty streaming component associated with this? Potentially?
Yes, potentially, yes.
Okay. You'll let us know.
Yeah.
Good. Okay. So you come back into market, raise some money to take you through for that particular portion. Are you going to need to raise any more money for the rest of what's going on, what your plans are for 2020?
No, that's 2020 spoken.
That's it?
Yeah.
Okay.
And then I haven't really explained the whole financing picture. The whole thing fits together rather nicely because once we get this small plant cranked up, that's then
get some cash.
Getting cash. Especially
when do you get profitable? When's the free cash?
This year.
Okay.
I mean, after the power comes on, let's see where we get to. But that's what I'm.
Can I ask about the power? I mean, we look at people in Africa, we'll call it, nothing specific, who have had and are experiencing sharp prices in energy costs. We see that a lot. We've seen shortages, as in people, power outs and so forth. What's Kazakhstan like from that regard? Once you're connected to the grid, I know from the oil days it didn't seem to be a problem, but just, is there?
No. Kazakhstan has a well-developed grid. the problem we have at the moment is we're getting power down a little local line which has wooden poles that blow over in the wind.
But going forward,
get ice. That once we connect onto this high voltage line, it's 110 kV. This is sort of big metal pylons, and it's connected to the main grid. That's very reliable power and very cheap power.
Okay.
We're very, very lucky.
So back to the financing. Tell me more.
Yes, the way everything fits together, we're developing the big project in 2 stages. First one is 1 million tons a year of ore. Second one is taking it up to 4 million tons a year of ore. Now the feasibility study is on the 1 million tons a year of ore, but if you can do it for one, the project is huge. You can do it umpteen times. $100 million roughly speaking for phase 1. Now once we've connected onto the power line and got this small part cranked up, that's making money. That underpins borrowing. It makes everything much easier.
But again, just help the viewers understand. Give me some numbers there. So it's producing. You're going to be economic at some point this year.
Yes.
Tell me dollars.
At our long-term price forecast of $7.50 is heavily dependent on that. We should be making about $10 million a year at that point, which is a very nice beginning. You know, we're not like the typical junior mining company with a. And
by making, you mean that's a net?
That's net cash flow.
Net. Okay, fine.
That helps to finance phase 1. Phase 1, this thing is very, very profitable. It throws off a huge amount of cash. You know, payback is months, not years. And so phase 1 will then generate enough cash to pay for the expansion of phase 2 up to 4 million tons a year. So to get to this 4 million tons a year, which is as far ahead as we're going, we could go higher if the market is there, vanadium flow batteries, for example. But anyway, as far as we're planning ahead, 4 million tons a year, that's 22,000 odd tons of vanadium pentoxide a year. We get there really for very, very little equity capital raising. As I said, most of that phase 1 cash will be debt. Some of the rest of it will be royalty sales or streaming. So this initial dilution that we're talking about, if it will be dilution, is really the only significant dilution we're going to have until you get to a $2 billion company.
Got it. So again, just recap for people. So your margin, you put a 750 number in there. You're making 78-79% margin on your production costs. You'll get into reasonably quick production, increase your production this year. Then it's a question of finding $100 million. You think it's going to be debt, probably, maybe some structured, maybe some royalty, maybe some streaming in there. But at that point, at 750, if the price remains flat, you're very, very profitable. But you can't do that till your feasibility number, your westernized feasibility number, is out. That's what you're saying.
That's right, exactly right.
Okay, fine. Okay, I mean, I'd be interested to sort of see, what the first financing is going to cost you, and how you structure that. I think that'll be fascinating to understand, and what the timing is for that. You're imagining that would be Q2, Q3.
Financing, yes. It's
at the point you will.
Yes.
Right. Okay. With any of this, are you going to have any downtime with the current plant? Are we going to?
No. We've managed to keep the plant going throughout. We've significantly increased the. And I should say that the plant started its life as the pilot plant for our main project. It was designed to treat 15,000 tons a year of ore from our mine. And having done its job as a pilot plant, we proved the process. We optimized the process. We then were faced with the decision to shut it down and lose all that expertise, all those people that had learnt to operate it, or keep it running. So we decided to keep it running, and to do that we had to buy in concentrates. We weren't ready to start mining our own ore, and it's more profitable to treat concentrates on a small plant like that. So we converted it to treat concentrates, but it was too small scale to be economic. So what we're doing now is building it up, debottlenecking it, tuning it so that we use the maximum capacity optimized for the raw materials we're treating. And we're treating different types of raw materials now. So we get the production up 10 times more than it was when we first adapted it.
Right. So this story to me sounds quite simple, but I want to understand why the market doesn't get it. Okay, so it was a private company for a long time. How many years before you went public last year?
12 years, probably.
12 years,
yes.
okay. What was happening during that 12 years?
Was
it doing something else?
Process design. Process design.
Right.
And then we built the pilot plant.
Right.
It took time to build the pilot plant, time to optimize the operations of the pilot plant.
Yeah.
And then there are complications of operating in Kazakhstan. They've actually largely gone away, but at the time we were doing it, there was a big complication in that it was in order to raise money, as the offshore owner of a Kazakhstan subsoil using company, we needed consent of government to raise money. Every time we wanted to raise money, even $1, or even one shareholder to sell his shares. So this is a very long story, and I'm sure nobody's interested in the detail, but it meant that we had to list the way to get round the requirement for consent to every single transaction was to list on the Kazakhstan Stock Exchange.
Right.
Now, until the advent of the Astana International Exchange, the old exchange in Kazakhstan is called Kazakhstan Stock Exchange, and they had various rules which made it almost impossible for a company like ours to list. So we had to reorganize our group, change its structure, do it in a way that didn't trigger capital gains taxes on fictitious paper gains, and it was a huge problem. It's taken 2 years really to do that reorganization.
Okay.
So we lost some time on that, but here we are now. We're operating. Of course, the vanadium market has done its own thing in that time. I mean, most of our history, the vanadium price was falling. It was quite high when we started, and I think around end of 2017 it dropped to $2.38 a pound. Now, that was not the best backdrop for raising a huge amount of money speculatively. So we've gone quietly and slowly, but we've covered the bases.
Okay. So what I was getting at is, is this team capable of moving quickly? Because 12 years there, year and a half doing this in a public environment, was that dint of what was going on in the country because it's a difficult place to work? You're saying it was, but it's not so much now. And are you therefore going to be able to work at a pace in this public environment to deliver what you say you're going to this year? Is there any reason why we shouldn't believe you?
No, we're following a well-trodden path. I mean, I've been involved. I was 14 years with Rio Tinto. And I've put several projects through from exploration phase to production.
What were you doing there?
I had various roles. The most significant was the group planning department for the Pillar Group at the end. That wasn't mining, but
was there any public-facing component to it?
Any
public-facing, as in public market?
No, I wasn't not in the Rio Tinto days. But since then, I've been CEO of Hambledon. We put a plant into production from exploration to full production, and we have the right team. We've got Tony Saunton, who's the mastermind of the feasibility study, and then will be involved in the project. He's ex-head of SRK in Kazakhstan. That's a big consultancy.
Dealt with him.
He knows what he's doing. And we have we've got SRK doing the feasibility study. All junior mining companies have to buy in the expertise to build the plant. We will get almost certainly a professional, well-known name to do the building.
So what are people not getting about your story? It seems quite clear to me today where you are and what you want to try and do. Your share price has been hammered. So what have you not done, or what is the market not getting? Where's the fault lie?
Yes, well, I don't want to sound like the traditional CEO complaining about the market. The market is, tells you something. I appreciate that, but I do think that the market has got confused. The shareholder selling.
Is that their fault for not paying attention to this, or are they getting confused elsewhere?
No. Of course, it's our job to explain it, and I think we will do. But nobody has to sell. I think that the fact that there has been some fairly heavy selling of people who have to sell, not people who.
Well, that's from the private days. You're saying that there was a hangar.
Yes.
overhang there. Hang over something else.
Overhang, I think.
Maybe both. But do you not foresee something coming in again? People came in at 70 cents. Do you not see an overhang happening there? If people the price gets back up, people are going to be like, well, is this story going anywhere? What can you do about it?
I think that at the moment there's very little liquidity. So tiny sales are hammering
Big
the share
impact.
price.
Yeah.
I think as the story gets more and more credible, feasibility study is a big part of that. Profitability is a big part of that. The company, of course, is cash constrained, and when you suddenly have millions of dollars to spend, you can do your PR much better, and investor relations. I think everything there is a virtuous circle scenario when as we deliver on what we said we're doing, and that news gets out to the market, particularly with the feasibility study, then the economics of the project, the efficient market theory works, but you need active trading to make it
do,
work.
but again, listening to the story, the feasibility will be out towards the end of this year. Why should people do anything between now and then when it comes to your price?
Because markets don't work that way. Markets don't wait for the event and then react. They anticipate the event. Now, I think as we get the story out, you're a part of this conversation today. We have many opportunities to get this story out.
Right.
And as the vanadium market stabilizes, as demand picks up, the market's going to anticipate these things.
So you feel it's got to come up a little bit? Well, it doesn't necessarily matter if you price-wise, but you think it will come up a bit?
It's likely to. We didn't talk about it earlier, but the economics of the industry are that the market for steel, ignoring batteries, we talked about batteries, but we didn't talk about the steel market.
Yeah.
The steel market is expanding. There is an inexorable growth in vanadium demand, and it's caused by two things: a sort of world GDP element, that's a 3% per year growth.
Yep.
And built on top of that is a technology change where countries are adopting higher and higher standards of particularly construction steel. So the West, North America, Europe uses a lot of vanadium all its construction steel virtually contains vanadium. And the rest of the world is catching up on those standards. And at the same time as the catch-up is occurring, the advanced economies are using more and more vanadium per ton of steel. So there's the 3% plus the technology change. So the sort of background underlying growth in the vanadium market is maybe 6, 7, 8% per year. Now that's 2 projects like ours coming on stream every year that it needs. And so that, I mentioned earlier that there's 70% of the market is currently supplied by co-producers. They're going to be a diminishing percentage. The market is going to be driven by new primary vanadium projects coming on stream, like Largo did. Bushveld have got plans, and there's us, and quite a lot of other TVM ones. And so you can look at the economics of those projects. Now, TVM is where the vanadium is. It's a very common element in the Earth's crust. And as the next TVM deposit off the block, the next most competitive gets developed, you can look at the economics. You can read the pre-feasibility study of Bushveld's Makopane project. You can look backwards at Largo's Maracas project, and you can see the economics of TVM development. And you can see that to justify that, building another primary producer from TVM, you really need $8, $10, $12 per pound.
Right.
That's what that published information is telling you. So that tells me that that's going to be the driver of the price. The price is going to have ups and downs, but as it goes up, it'll justify building a new project, and that will bring it down. And that price level is probably $8 to $10.
Yeah.
So in using $7.50, we're being
interesting point you make there. Really interesting point you make. It's publicly available. Now we deal with retail investors, family offices, high net worth who don't have access. MiFID 2 came along over here certainly and kind of made it harder for that audience to get institutional level research. You're saying go and look at people's feasibility studies, try and understand. It might be slightly dated, but there's some level of forward-looking statement on there, and say try and understand the market, buy into the thesis for vanadium. The numbers are there. That's where you should go and look. So you said this. That's a good bit of advice. But apart from that, where else do people go and try and understand a little bit more about the vanadium market, and indeed you guys? Because there's not a lot of information around for this retail audience.
Yes. Well, our brokers, Shore Capital, issued a very long, comprehensive research note. Now, unfortunately,
is that available?
We're not allowed to put it on our website.
Okay, so back to square one. So what do we do? What do we do?
I think anyone can ring up Shore and ask for it. That's
right.
the first thing to be said.
Okay. What do they know?
They sent an analyst, a very good analyst who's been to site, spent time there, knows the vanadium industry, knows mining, knows vanadium, and I think it's 70 pages or something. It's a huge document.
Worth trying to get a hold of.
Their take on us was best in class. That was their headline number, and they produced one of these bubble
Do you pay them?
charts. Of course we do, but nevertheless we can't control what they can't say things they don't believe. But yes, it's paid for.
Okay.
Now we can pay for more research, independent research. It's a money thing and time thing.
Do you think it's worth it? Because I'm hearing finance side of things, you seem to know what you want to do, and it's a question of how those conversations manifest themselves and the terms that you get. The feasibility is the key to unlock those conversations going, moving forward. Technically, you seem to know what you're talking about. The asset is great. You've not done a lot of market-facing stuff in terms of telling people the story. Perhaps again comes back to feasibility, or you feel it's down to the feasibility. What are you going to be doing going forward? And you're saying it comes down to money, but don't you think that's maybe where you should be spending money, telling people the story? People understood this because, like I say, I've heard it today. I'm like, okay, that makes sense. Are you telling it enough, and are you putting enough value on telling it enough?
Well, I think what the market price is telling us is we're not telling the story well enough.
Right.
That's conversations we're having internally and with our advisors, how to tell that story. It has become more difficult to tell the story now that research is less done and less available, but nevertheless it's our job. I think you made a good point.
Okay, so to finish off, I think I've possibly done it for you, but give us those 5 key selling points as far as you're concerned, and possibly in priority order. What do people need to know? Okay,
what they need to know is, first, we have a very large scalable deposit, big enough to impact. We can supply the whole world with vanadium for 5 years on our own. Expect it. Needs a little bit of a little bit more exploration to get to prove it all up, but that's the scale we're talking about. We have a cost structure because ours is not a TVM deposit. Our cost structure means that we have about a cash cost of production only about 40% of the best of the TVM producers.
Brilliant.
So very low cost structure and huge scale means we transform the world of vanadium. Third one, the market is growing strongly, even without vanadium flow batteries. I explained 7, 8, 9% a year is the background growth. Now there's the noise of booms and busts and cycles, which is going to produce ups and downs in the vanadium price. But that's the underlying growth rate. That's been shown by history, and there's every reason for it to continue. China has been part of that story when they've introduced new construction standards. Okay, I think that's three. Those are I'd rather stick at 3 and not dilute the story. Those are pretty compelling.
Great. Nick, appreciate your time today. Thank you very much for coming in and seeing us.